Hi, good morning. Yet another Friday. We getting back to the discussion of the mock paper to continue to provide video discussion on the questions that on mock paper for financial accounting of ACCA. Today, let me start with question number 29. Question number 29 speaks about Fred's trial balance did not balance. So he opened a suspense account with a debit balance of 346. Control accounts are maintained for receivables and payables. Fred discovered the following. The sales day book was undercast by 400. Purchases of 520 from the purchase day book have only been recorded in the payables ledger control account. Profit on sale of non-current assets 670 had been recorded in the sundry income account as 760. What is the remaining balance on the Fred suspense account after these errors have been corrected? What we should first do is that we should open up the suspense account. This is the suspense account. Let me change the color of the pen. And this was the balance given in the question. A debit balance of 346. After arriving the trial balance, due to the disagreement in the trial balance, there has been a shortage of 346 on the debit side. Or rather, 346 is more. Shortage on the credit side is 346. Example, if I give you example, this is your trial balance. If the total on the credit side is 1346 and the total on the debit side is 1000, so you have 346. So this is what they are referring to here. So the suspense account balance is that, and then they give you three transactions to make ourselves understand which one is suitable to rectify the error that is reflected in the trial balance. First one, the sales day book was undercast. You have to clearly understand the sales day book is a document that is prior to. So if I draw this line, after this checkpoint, this area is with double entry, and then this area is pre-entry region. So here no double entry. So when you don't have double entry, then that won't have any impact to your trial balance. So the sales day book transaction is a prime entry book, and that has got nothing to do with the double entry. So any mistake that taking place in the sales day book will not have an impact or reflection to your accounting entries, and this will not lead to any disagreement in the trial balance. Accordingly, first answer is not correct. So we don't need to worry about it, in other words. Second one, purchase of 520 from the purchase day book have only been recorded in the payables ledger control account. When you read the name payables ledger control account, that is part of double entry. And what the bookkeeper has done, he has only taken to the payables ledger control account. And also they say that it's recorded there. Payables ledger control account entry is credit. So the correct double entry must be, you should debit purchases and then you should credit payables ledger control account, whereas this entry was not taken place. So now what we have to do is we need to complete that. So I should debit purchases, and then where to credit, I should credit to suspense account. That is the second entry. So I should credit here. So that is the second transaction. Third one, profit on sale of non-current assets of 670 had been recorded in the sundry income account as 760. This is known as transposition error. A transposition error, you see, 760 and 670. So what you need to see is that what is the difference? The correct entry is this. This is the correct one. And this one is the incorrect one. So it has been overstated in the income. So we need to reduce that. So I should debit sundry income, and where to credit, again suspense account. When you balance this account now, you are ending up a difference of 264 on the credit side. So let's find out the answer. So the first answer, 264 credit, that is the correct answer. Charles' company entered into the following transactions. He made a credit sale to Mary, allowing 5% trade discount on the list price of 640 and a further 5% discount for immediate cash payment. So there are two types of discount they are discussing here. One is trade discount, other one is cash discount. Also, please remember, trade discount we don't take into account for double entry purposes. That is just prior to complete the invoice. So those information will not reflect as part of double entry. However, cash discount after completing the double entries only, at the time of receiving the cash we do this. So which needed to be recorded as part of our accounting entries. And one more thing, the first example is a discount we allow, it's an expense. Second transaction, he purchased goods with a list price of 600 and received 10% trade discount and further 2% discount payment within 7 days. But he paid 3 days later. From the date of transaction, he paid 3 days later. That is still within the comfort zone of 7 days. Accordingly, so he is entitled to receive this 2% discount. What is the question now? How much discount should be recorded in the discount received account? So income. So when come to discount received account, we don't need to worry about the transaction number 1. We only need to worry about the transaction number 2, and the calculation will be, this is the calculation, 600, and then you need to remove the trade discount. So what I will do, I will work it out 90%. Meaning 10% is the trade discount. So the net answer after the trade discount would be 90% of the invoice value into what is the discount that you are receiving as cash discount is 2%. So this calculation only you need. Let's work out. So if I do that, 600 into 0.9 into 0.02. So 10.8 is your answer. And let's find out we have such an answer there. Yeah. Option number 1. So that is answer to question number 30. Now question number 31. Where in a company's financial statement complying with international financial reporting standards, should you find the proceeds of non-current assets sold during the period? Now the question that they are asking is, if you are selling any non-current assets, the cash that you receive, the proceeds, where would you be showing this? Should you find the proceeds of non-current assets sold during the statement of cash flows? Obviously, we need to show it in the statement of cash flows and statement of financial position. No, we will not show in the statement of financial position, only in the statement of cash flow. Statement of changes in equity, no, there we won't be taking anything of proceeds from sale of non-current assets. We will not be taking to statement of changes in equity, neither statement of financial position. Statement of profit or loss, remember, in the statement of profit or loss, what you show is the profit or loss on disposal. But the question is, they are saying proceeds of non-current assets. So we will not be showing there either. The answer actually statement of cash flows only. Question number 32. If the current ratio of a company is equal to quick ratio, you should first understand the equations. What is current ratio? Current ratio is equal to current assets divided by current liability. That is the current ratio, whereas quick asset ratio will be current assets minus inventory divided by current liability. Now let's read the question. If the current ratio of a company is equal to its quick ratio, which of the following statement is equal? Now, for example, if my current ratio is 1 and my quick ratio also 1, that is the answer what they are saying. Accordingly, what they are saying is, what they are asking is that, what could be the possibility? The current ratio must be greater than 1. No, the company does not carry inventory, carry any inventory. Possible. Receivable plus cash is greater than payables minus inventories. No. Working capital is positive. Answer is actually second one. Company does not carry any inventory. If the company do not carry any inventory, your current asset will be equal to, let's say it is without inventory 100,000, no inventory here, and your current liability, let's say 50,000. So now let's calculate current ratio. 100 divided by 50, answer is 2. Let's calculate quick ratio. 100,000 minus inventory 0 divided by 50, again answer is 2. So here the answer is the company does not carry any inventory. Question number 33. The closing inventory of Epsilon amounted to 284,000. So let's work it out. So inventory reported is 284,000, and then they're talking about two different instances. 500 items which had cost 15 each and which were included at 7,500. So you have one item here, they have considered as included at a cost of 7,500, item A, and then what they say, these items were found to have been defective at the end of the reporting period. Remedial work after the reporting period cost 1,800 and they were then sold for 20 each. Selling expenses were 400 actually. So this is the cost. Now I need to calculate NRV. What is NRV? Future selling price minus estimated selling cost plus estimated completion cost. So the future selling price, they have given you 20 into how many items? Let's work it, find it out. 500 items minus, and then what they say, 1,800 we need to do some remedial work, which is completion cost, plus 400 selling expense. So 20 into 500 is how much? 20 into 500 is 10,000 minus 1,800 plus 400 is 2,200. So that means 7,800 NRV, whereas cost is 7,500. See, according to IAS 2, inventory should be valued at lower of cost or NRV. As per this condition here, which is lower, the cost. So we don't need to do anything on the item A. Now let's look into item B now. What they talk about item B, 100 items which had cost 10 each. After the reporting period, they were sold for 8 with selling expense of 150. So item B now, 100 items and they were sold for 10, so that means 1,000. Now what is they are saying that the cost is 10. After the reporting period, they were sold for 8. So 100 into 8, which means 800 minus, and then they had selling expense of 150. So that means 650. Here NRV is lower than cost, so what you should do, you should subtract minus 1,000 and then add how much? 650. So that is the revised answer. So let's work it out. 284,000 minus 1,000 plus 650. So 283, 650. So you have that answer there. That is option number 1. And now going to question number 34. Which two of these statements about research and development expenditures are correct? This is IAS 38, intangible assets. So here, especially research is an expense. With no further questions asked, you should write off the research expenditure straight to profit and loss account. Development could be capitalized subject to it satisfying certain conditions. So first answer, if certain conditions are satisfied, research and development expenditure must be capitalized. Wrong, because research word is there, so this option number 1 is wrong. One of the conditions to be satisfied if development expenditure is to be capitalized is that the technical feasibility of the project is reasonably assured. Yes, that's correct. So that is the correct answer. The amount of capitalized development expenditure for each project should be reviewed each year. Yes. If circumstances no longer justify the capitalization, the balance should be written off over a period not exceeding 5 years. No, that is wrong. There is no such provision in the standard. So that answer is wrong. Development expenditure may only be capitalized if it can be shown that adequate resources will be available to finance the completion of the project. Yes. See, to satisfy development expenditure to be capitalized, there are certain conditions. So one is that you have adequate resources, and then you have technical feasibility, you have market feasibility, you have management intention, you have the projected revenue is greater than the cost of the development. At the point when the revenue is less than the cost, suppose this is 100 and this is 120, then what you should do is that you should only capitalize 100 and the 20 should be written off to P&L. So anyway, answer is second and fourth. And the last one, a company measures the average time to collect receivables. The equation is given: receivables at the end of financial year divided by annual credit sales into 365. According to ratios have just been calculated from the financial statements for the year that has just ended, these show an abnormally high average time to collect receivables compared with ratios calculated for the previous financial year. Which of the following may help to explain this unusually high turnover for a trade receivable? There was unusually large sales on credit close to the end of the financial year. Obviously, when you have more credit sales and high credit sales, then what is going to happen? What is going to happen is that your receivables will be more. When the receivables will be greater, then your receivable ratio will be high. So option number 1 seems to be correct. The company has seasonal trade and the sales in the final quarter of the year are always higher than in the other quarters. No, that's not correct. However, sales in the final quarter of the year just ended were lower than, no, that's also not correct. So answer is the first one. With this, thank you so much. And I will continue to develop and present the next part of the section B in my forthcoming videos. Thank you for watching this video. Do subscribe and share, and also don't forget to press the like button.